Okay, this is the last video of this lecture. So the topic is analyzing policy options for reaching internal and external balance. So first, we explain the internal balance. So internal equilibrium is the situation that aggregate demand equals to the full employment level of output. So aggregate demand is like this: C plus C consumption plus I investment plus G government expenditure, and CA is the current account. Then C plus I plus G is called absorption. So we denote A as C plus I plus G. So therefore, aggregate demand should be equal to the A plus CA. In CA, E is the exchange rate, and A is the absorption. Recall that this current account is dependent on the exchange rate and absorption. YF is the full employment level of output. And here, A plus CA, we let A plus CA as Y. So there is no F. So this is simple Y. So this is simple Y, and this is YF, full employment level of output. So aggregate demand Y should be equal to the full employment level of output YF. So this is internal equilibrium. Sorry, wait a minute. Okay, so then internal balance condition is like this. So let's consider the case of an increase in the government spending, G. So when G increases, here, domestic demand or absorption increases, but the current account here decreases when A increases. So recall that absorption approach in the current account. So current account can be defined as national income minus absorption. When absorption increases, given to the national income, when absorption increases, the current account decreases. If A increases, then CA decreases. Therefore, if the government spending G increases, then the current account decreases. So therefore, the sign of the Y change is ambiguous. A increases, but CA decreases. So therefore, the sign of Y is ambiguous. But if rise in the absorption is greater than the decrease in the current account, then Y increases. Also, let's consider another case. Devaluation or depreciation of the exchange rate, E, occur. Then A doesn't change because A does not depend on the exchange rate. The current account increases when the devaluation of the exchange rate occurs. Then Y increases. Like that, government or policymakers can control G or E to achieve the output at the full employment level, YF. So policymakers maintain output at full employment level, YF, by moving G, government spending, or exchange rate. So let's consider the graph. Okay. The horizontal axis is domestic spending A, and the vertical axis, okay, so the vertical axis is exchange rate E. So there are downward sloping curve here. So at this downward sloping curve, the internal equilibrium is achieved. So economy can achieve internal equilibrium along this line. If the economy is below from this line, the economy is unemployment. If the economy is above from this line, then the economy is overemployment. Okay. So this line, this downward slope line, is that the economy can achieve the initial internal equilibrium. If the economy is below from this line, economy is unemployment. If the economy is above from this line, then the economy is overemployment. Okay, we call that monetary trilemma. So under the fixed exchange rate, monetary policy for the domestic economy is not effective in general. So policymakers can control only G and E for achieving full employment, but they do not control monetary supply. Now move on to the external balance. So the government target for the current surplus to be, so let the current government target for the current account surplus should be X. So X is a target for the current account surplus. External equilibrium is that manage exchange rate E and this domestic spending A to meet the following condition hold. So current account should be equal to the desired level X. So rise in the exchange rate E improves the current account balance, and rise in domestic spending A worsens the current account balance. Sorry. So let's show this graph. Again, the vertical axis is exchange rate and horizontal axis is the domestic spending A. So there is an upward sloping line here. At this line, external equilibrium is achieved. The economy achieved the external equilibrium. So this line is the equilibrium line. When the economy is below from this line, then the country suffers current account large deficit. If a country is above from this line, then the country surfaces the large current account surplus. Then combine these two graphs together. So like this. So there are 4 zones of economic discomfort. First one is overemployment and large current account surpluses. Second one is overemployment and large current account deficit. Third one is unemployment and large current account deficit. And fourth is unemployment and large current account surplus. At the center line, at the center point here, economy can achieve both internal and external equilibrium. So this is the internal and external equilibrium. This line is for the external equilibrium, and this line is for the internal equilibrium. So let's simplify these lines, internal and external equilibrium. So this is the simplified version of the internal and external equilibrium. So along II line, so this blue line here, II line is the internal equilibrium. And XX here, orange line is the external equilibrium. At the close point in the graph A is the equilibrium. Both internal and external equilibrium can be achieved. Suppose that economy is here now. Economy is at point B here. Here is far away from the equilibrium point A. So to achieve the equilibrium point A, the policymakers control domestic spending and exchange rate. So first, policymakers try to control domestic spending to achieve the equilibrium point A. Then government spending increases. So the policymakers increase government spending. Then economy moves to here. Then domestic equilibrium, at here, domestic equilibrium is the same level as point A. Now, policymakers controls exchange rate, E. Then, policymakers devaluate the exchange rate against the domestic currency. Sorry, the policymakers controls and devaluates the domestic currency. Like that, from here to here. So then, policymakers can keep the economy at the desired level, point A. So point A is the external and the internal equilibrium. So policymakers can control domestic spending A and exchange rate to keep the exchange rate, so to keep the equilibrium at the desired level. Like this. So this is an example of a policy for keeping the internal and the external balance. So this is the end of the lecture. So we will cover, so far we covered that during World War I, what kind of monetary policy and the international monetary system was conducted. During World War I, gold standard was stopped. And then many countries print money and which caused inflation. So gold exchange system is different from gold system. What was that? So please check the gold exchange rate, gold exchange system. So the Great Depreciation, how do governments react to the Great Depression? So against the Great Depression, many countries try to restrict trade, so which caused trade war across countries. So they imposed they imposed import tariffs, very large import tariffs, and then world trade was shrinked. And which caused, so the shrink, so the trade war, so such trade war spreads the effect of Great Depression. So the gold standard wasn't the impact of the Great Depression. Why? Please check and review that. Why Bretton Woods systems? So Bretton Woods system was, so at Bretton Woods in the USA, many countries, like I forget the number, but many countries signed IMF agreements. So the characteristics of IMF agreements consists 4 characteristics. So there are 4 characteristics of IMF agreements. So as international capital flow grows, what kind of crisis occurs? How does the exchange rate react? So then balance of payment crisis occur as capital flow increases. So to achieve internal and external balance, what kind of policies are effective? Recall that monetary policy is not effective during under the fixed exchange rate system. So only government spending, so only for the government expenditure, for government spending policies or exchange rate intervention is effective, to achieve internal and external balance. Okay, so this is the end of lecture. So if you have any questions, please mail to me. Okay, so thank you for listening. I hope you enjoyed this lecture. So bye.